So we're looking at the weekly chart of the dollar index. If you did not watch July 9th, 2023's market review video on the YouTube channel, go back and watch that first, because without having seen that first, you're really not going to fully appreciate what's being shared here. So we talked about this fair value gap here on the weekly chart. This is completely permissible for price to do this type of thing, wicking through it. And I mentioned that we would likely draw to the sell side below here and then below here. It got a little animated on the downside, and I'll take your attention right over to here. It was just, I think, one tick or so short of actually reaching the high of the gap, and this is from the week beginning April 11th, 2022. Okay, so that's this week right here. And the week beginning March 28th, 2022, the high of that candle. So that makes that fair value gap here. It's a buy-side imbalance, sell-side inefficiency. So we'll watch and see if it wants to dig into that going into this week. Apart from that, I don't really have a whole lot to share in terms of prognostication. Daily chart. Okay, in the commentary in July 9th, 2023's Sunday review and analysis before the market even opened up, I mentioned that this is the breaker that you want to be watching, and this is where we had closed for that particular week. We opened, traded up into the breaker, okay, and what I'm showing you here is the low to the high. Midpoint of that is mean threshold. Order blocks, the midpoint is mean threshold. Gaps are inefficiencies, the midpoint is consequent encroachment. You can see we traded up into it here, hits it beautifully, then delivery to the downside. So there's Monday's trading. Tuesday, we finally made our way into this fair value gap and accelerated to the downside, attacking the sell side, as I mentioned we would likely do if we traded accordingly on Monday. Go back and listen to July 9th, 2023's analysis. Before the market opened up, we were anticipating the return back into this breaker. Does it deliver off that breaker? Yes. So that means we can anticipate this area here, sell side draw. Okay. But sometimes I'll get a comment saying that I'm teaching, like for instance, the sell side here. They'll suggest that I'm calling sell side support. No. I'm teaching you to view how the market will draw to that liquidity, to it and through it. Okay, to it and through it. Buy side is not resistance. Buy side is a draw on liquidity for markets that are going to go higher. We want to tap into that buy side liquidity that's above old highs, relative equal highs, or single highs. So it's not a matter of support and resistance. Support and resistance is garbage. Okay, let's just be real frank with one another here. I don't believe in support and resistance, but I have methods that will teach you real dynamic support and resistance, and that's my inefficiencies and gaps. Okay, so the way I use gaps, they're not filled and done away with. The market many times will revert back to an old gaps, high, low, or consequent encroachment. There's three specific price levels that I'm looking at that I'd like to see. And if I'm going to use the range for targeting or determining whether or not the inefficiency is going to provide a means of staving off continuation, then I'll put the four gradients on that level too. So it's either I'm looking for it as a target or I'm looking for it as a entry, and vice versa. So we're not looking at this level here anticipating this to be some measure of support to buy from. That's not what I'm doing. So the breaker in here, you can see we hit that and we worked off that weekly fair value gap, and I mentioned in the July 9th video that it doesn't look like there's a gap at all in here, which is the reason why you want to transpose your weekly inefficiencies onto your daily chart. And you won't lose sight of what the higher time frame context is if you do that. All right, so let's move on over to euro. So euro dollar weekly chart. I've been counseling you all for months now to anticipate this weekly volume imbalance. Okay, so yes, you can see how the market has drawn price up into that. That's algorithmic price action. So we looked at this weekly inversion fair value gap. Okay, and this again is not a liquidity void, find a sell signal here and sell off. That's not what we are looking for. Okay, we are looking for this level to act as support. So that's what makes this a ICT inversion fair value gap. All right, and you can see how we opened for the week. We traded down. Admittedly, we did not match the low of this candle with the low of that one. Don't be fooled by the visual representation that's being shown here. But for the spread, you would have been, you would have been stopped out if you were long. This has been honest. The broker would open the spread up on you, and you would have been tagged and stopped out before you would have been able to capture any of that move. But the idea was, I was teaching you on Sunday, July 9th, 2023, that it would trade down to that and then run up to the buy side here and into this weekly volume imbalance. Let's drop down to a daily chart here. Okay, you see Monday's trading, we traded down towards the weekly inversion fair value gap. Rallies. Tuesday, we have a small little indecisive day, and then explosion on Wednesday, taking the buy side and trading right to the low, looking very close, right at the low, the weekly volume imbalance. And then we open, find some support at the weekly volume imbalance, rallies. Friday, we have a little bit of continuation. So the only thing I have going into this week is I want to see it completely close that in. That's it. Now, when I share my analysis and the market runs to these levels and it delivers as I outlined. All right, so here's the hourly chart here. And you can see how we just fell short. If you look real close, we just fell short before touching the high end of that weekly inversion fair value gap. And the market rallied, came back down, found some support, right in a fair value gap. Rallies again, comes into another fair value gap, and rallies, and right in here it creates a measuring gap. What makes this a measuring gap? Well, we're anticipating price getting as high as this shaded area up here, which is a weekly volume imbalance. And we anticipated this here acting as what? Some measure of instigation of a new rally. So to speak in simple terms for you, this is not classic support and resistance, but I'm going to use the idea so that way you can follow along in terms of context. We anticipated the top of this area here that's shaded in orange. I guess it's really not orange, is it? It's a hue that's very close to orange. And then we expected that to act as support, and then we would look to see it get to this level here, which is the old buy side liquidity. We didn't see it going there and then coming back down. We did not talk about that. I did not say that was going to happen. I said that we would go to that, through it, and then trade into this range. Now, what levels am I talking about when we get into these ranges? I'm going to cover that in a moment, but let's go into a little bit more details here. 15-minute time frame. You can see 2 down closed candles here. That's a bullish order block. Consecutive down closed candles. Small little gap there. Extend that forward. You can see how the market trades down into that, and then rallies. Inversion fair value gap. The market finds support there. Rallies up. I have lessons and lectures and discussions with inversion fair value gap, so you'll understand more about that. So here's that measuring gap. Moves up into the low of the weekly volume imbalance, and then we find support at the weekly volume imbalance. You see that? Look at that. That's beautiful. Now, if you would have never known about the weekly volume imbalance, you would have never seen that as a level to anticipate the market wanting to go higher. Market pulls back down into a small little gap in here. Rallies again. Right in here, we have a bullish order block. Right there, extended here. An optimal trade entry as well. And then it rallies and continuously moves higher. All right, moving on into E-mini S&P. This is the seasonal tendency chart for E-mini S&P. And I'm going to take you back in time for a couple minutes in our conversation here. And I talked about how I like seeing the seasonal tendency that comes in the month of May, leading into June. June typically makes a really strong low, and that's just about every single year. Okay, that one's really, really strong. But I like having a shorting opportunity going into the last week of April, going into May, and then majority of May, we see some measure of selling. Well, this year, while we were anticipating it, the market internals did not present that idea in technicals. So while I was expecting and looking for it, we didn't do anything that would get us short and take a loss. What we were doing is we were seeing the market show us that it's not likely that the seasonal tendency was coming into fruition this year. So this little movement right in here, okay, that's what I was looking at. That is a really easy breadwinner for the springtime, and it was not there technically. But I want to take your attention into how the third week of May and the third week of June, okay, see how we have June, July, May, April. This is approximately the third week of May and the third week of June. See that? This right here tends to be one of the best times to be a buyer of index futures for E-mini S&P. So if you're looking for a really strong mid-year point to buy, if you are in a bull market that you feel that is going to continue, because we didn't see a seasonal tendency come to fruition here, okay, and I counseled you to do this in my mentorship, and you view the seasonal tendencies. If they don't form, if they don't come to fruition, that's telling you something that's extremely fundamental to the next drive higher or lower. If it's not moving in tandem with what you would expect in terms of the seasonal tendency, that means it's doing something opposite. So if we were anticipating what? Lower prices for ES or E-mini S&P, and it's not willing to do this, that means we're extremely bullish. So go into your charts on the third week of May and the third week of June. All right, so here's a weekly chart of E-mini S&P. This is the September contract for 2023, and there is the weekly volume imbalance I mentioned multiple times, and I said right between these two levels here, that point is the exposed area where there is no volume. So there's a real gap there, okay? So that makes it what? A liquidity void. That, my friends, is a liquidity void. This, from here to here, that is not a liquidity void, okay? But a real liquidity void is a void of liquidity. All liquidity. So that's what distinguishes me from everybody else out there, because I will tell you this is an inefficiency. It's a sell side imbalance, buy side inefficiency. So it's inefficient in up or buy side offering. The market only went one side heavy-handedly, and it's more likely to offer movement on the upside. And we see that over here on this candle here. Each one of these candles is a weekly candlestick, by the way. So we traded up into this gap or real liquidity void between this week's low and this week's high. Majority of the entire weekly volume imbalance. So we finally got to that one, okay? Let's take a closer look right inside that small little gap, okay? So before I go to the next slide in our presentation here, I want you to understand that what I'm going to do is I'm going to zoom in to this small little segment of price action, and I'm going to show you the relationship between this week's low here, this candle, and this week's high. We're going to measure that with the Fibonacci, and we're going to get the midpoint of that, which is consequent encouragement, because it's a gap. Here we are zoomed in. Here's that candlestick. We were looking at the low for Monday, April 4th, okay, that week of 2022, and then the 18th of April 2022. So this candlestick's high of its respective weekly candle, this candlestick's low of its respective weekly candle, drawing our fib from that level to there. All we're doing, we're using the fib to get a perfect halfway point, 50%. That means 45.59 and a half. That is your consequent encouragement of that small little gap that's right here, that little gap. Okay, so I'm finding half of this between this red line and that red line. I want to know what the midpoint of that is, the exact midpoint. That's what's being shown here, 4,559 and a half. Taking us over to the current present week, you can see how we traded right up into that consequent encouragement here. Went above it just by a little bit, but look how beautiful the reaction was from here back down in, and we closed on the highs. Not at the highs. We just fell short of going into the 20% retracement for TGIF. All right, so let's go into a daily chart here. You can see the fair value gap. We mentioned that at the time. 2 down closed candles, that's your bullish order block. Extend that to the right. We had a start of the week. We traded down into the order block and then ripped higher, taking out buy side, digging into the low of the weekly volume imbalance, the consequent encroachment of the entire shaded area, which is the weekly volume imbalance, and then those 2 red levels up here, and then its respective consequent encroachment or midpoint of that gap that's being shown within the weekly volume imbalance. Just a really beautiful delivery for ES this week. NASDAQ was actually better, and we'll look at that in a moment, but let's drop into a lower time frame here for the hourly chart on ES. You see how we dropped down into the order block, rallied through, bullish order block. This is down close here, and we have a fair value gap that makes this a proper bullish order block because we're in context of a buy program. We're looking for higher prices. Everything should match there, and we're seeing a noon, lunchtime, New York local time, return back in to imbalance, order block, sell side taken below relative equal lows, and then starts to trade higher. Another order block here, trades higher, an aggressive run through the short-term high here. So we're not looking at that as buy side, which is resistance, right? No. We're looking at it going to it, being drawn to that area, and then through it. And I don't need it to trade back down to this high. That's classic support and resistance. I don't need that. I want to see it trade inside of this inefficiency right here. Right there. Right in here. That's institutional order flow entry drill. And then rallies again. Trades up into that weekly volume imbalance. Look at the bodies respecting the weekly volume imbalance. Yes, we have these little mohawks. That's inherent price action. It's normal to see that. It's perfectly normal and acceptable. Market rallies, trades up into the consequent encroachment of that actual liquidity void in the upper portion of that shaded pink area, which is a weekly volume imbalance. Here's a 5-minute chart. You can see again with the ES trading up into that consequent encroachment of the actual liquidity void at the higher portion of that weekly volume imbalance. And right in here, you can see a small little SIBI, which is a fair value gap, sell side imbalance, buy side inefficiency. That means the market will likely pull back up into that. It does essentially the consequent encroachment. We can see those measurements here, trades to it here, and then we want to see a sharp displacement lower. Do we get it? Yes. Did it take out a short-term low? Yes. What is this? That's the 2022 model I taught you on this YouTube channel. Fair value gap, trades up into it here, boom, that's a short. What do you aim for? The low under here? Delivers. And we have a small little fair value gap there, offering the 2 o'clock silver bullet. The market breaks lower, relative equal lows, we pull back up, retraces, and then aggressively runs lower off of hitting a breaker. High, low, higher high, this candle's your breaker, trades to it here, sells off going into the 3 o'clock hour. Small little fair value gap there as well. So we have high, low, return back in. This is model 22 again. Sell side hammers it in the final hour of trading on Friday. All right, here's NASDAQ. This is our weekly chart on NAS. So you can see the weekly fair value gap there. We traded down into that 2 weeks ago. And this is this present week. So we opened, traded down, aggressively moved higher, made a high, and then come off the highs. I want to zoom in on that. So we're zoomed in on the weekly chart for NAS, and I'm taking the Fibonacci and measuring from the low of the week to the high of the week. And I'm showing you the respective 20% and 30%, which is TGIF. So whenever you have a nice big run higher or lower, those are the times you want to look for TGIF. They're really likely to have these pullbacks towards the end of the week. And how far will it pull back? 20 to 30% of the weekly range entirely. So you can see that 15,698.5 is 20% of the weekly range for NASDAQ. So that level is going to be important going forward in this presentation. So 15,698.5. That level is being noted here. and it's the weekly TGIF 20%. It's a short little abbreviation for thank God it's Friday. Okay, so it's a way for you to remember that that model is a day of week specific model, and it's capitalizing on treating a reversal of the entire weekly range to a 20 to 30% level of the entire weekly range. All right, so let's go into the hourly chart. Okay, so we're going right to the brass tacks with this because it's already a long video. I want you to take a look at the low here, the high, and the lower low. And the market trades through this high. We don't look at that as resistance. Okay, there's buy side above that, and we're looking for higher prices beyond that. But what can we use this information for in terms of finding range? Well, if you look at the teaching I gave you on advanced ICT breakers, those ideas that I shared in that video, I'm applying it here. So when we see the stop run here that takes out the sell side below here, my eye goes right to the low, to the high, prior to the lower low that qualifies this as a bullish ICT breaker. So this is your measuring range. So you take your Fibonacci, apply it to the low, to the high, extend it, do multiple extensions. You can do extension standard deviation -1. Here, negative standard deviation 2. Comes in at what price? 15,856 and a quarter. It's not the actual high, but look how close it gets you. That's projecting a weekly range high. This breaker, we expect it to trade through it. It does. We come back down into it. The bodies are respecting the breaker. It's not the fact that it goes up to this high and it repels price. That has absolutely nothing to do with it. Why don't you apply it to that high there? Because it had a nice retracement off of it too. So why is price not showing any willingness or respect of it over here? Because it has nothing to do with why price goes up. The logic is this. Short-term entries, those that are in the pursuit of trying to go long, they were right prematurely until they were stopped out. So this perfect trap here sets the stage for those individuals that got stopped out trying to get long. They're too afraid to get back in, especially when this one more wipeout that takes out this low, which also took out that low. So we see a 1, 2, 3 drives pattern. That is a classic retail pattern. Yes, it does work if you have the context, you know, in the draw and liquidity where you're trying to aim for. If that's correct, that pattern will work for you. If you see a level or a direction fail after 3 attempts and it breaks down, if you see a breaker or a model 2022 inside of that, oh, wow, what a beautiful model. I probably said too much, but anyway, the longs that have a sell stop below here, they get stopped out. They're not going to go back in. They're scared. They're not going to get back in there. But now the market will revert back to the individuals that are short here. Someone's short, so they're going to run on them. So the sell stops are being accumulated by smart money going long. They're buying those sell stops with the purpose of offsetting. So offset distribution is being used above this high. That's not support resistance. That's selling above a level for profit taking and waiting for confirmation that it wants to go higher. It does. The bodies are respecting that high, which is a breaker. It's not showing any willingness to show the bodies respecting this high anywhere in here as support. It's not happening. So the market resumes going higher. Pay no attention to this level yet because it has to make a high of the week first. So when we had this big capitulation, this run up into a standard deviation of -2 on this range. Then we have these relative equal lows, and the market draws down into that in the latter portion of the day, but back down more specifically into the weekly TGIF 20%. So after we see this level hit, we want to see, does it really want to break down from that? And then when we look at the lower time frames, we actually will see that actually occurring. So here's the 15-minute time frame. Here's the consolidation in the beginning of the day. And we had a report come out, sends price higher. Then we have this gap right there. Okay, so this returned back into this SIBI, which is a sell side imbalance, buy side inefficiency. Market trades into it here. We wick past it. That's completely permissible. Breaks down again. We have another gap. So this is institutional order flow entry drill where it just trades one little bit above this candle here. This happens on all time frames, but the context is you have to know where the market's likely to go. And because we have this gap here, and then we have this gap here in close proximity, that's what makes this an institutional order flow entry drill. Otherwise, if this wasn't here, I would expect it to trade more into this inefficiency. I'll have more of that in my books, but that's enough right here to send you light years ahead of everybody else. So the market does in fact trade below here, completely runs over top of this buy side imbalance, sell side inefficiency. Okay, does it here, and we have another gap there. We trade up into this, and then rips right through sell side here and sell side there. So we're not looking at that as buy, is because it was a turning point in the past for classic support and resistance idea theories. We're looking for it to trade through it because there's liquidity below that. And 20% of the weekly range is here. So all of these things match in terms of a draw on liquidity. There's a reason to anticipate it happening. The market's been going straight up all week, and then now we're at the end of the week. So this is completely acceptable and reasonable to see in price delivery. And it's not to say that we've called the top in the marketplace, because as I mentioned in July 9th, 2023's analysis, I'm teaching you not to try to pick tops and bottoms on higher time frame charts, because you can hurt yourself doing that. Just wait for the market to clearly show you it's reversed. And when it does, just keep working that bias that's in the market at the time. And try not to fancy dance it and try to pick a top or bottom, because you're not going to get it correct. You're not going to do it. So to avoid that, just simply try to stay on side and trade with a expectation that the higher time frame weekly chart moving into a lower time frame daily chart, that's enough for you to find opportunities and not need to be picking tops and bottoms. Okay, here's a 5-minute chart, and I'll show you the inversion fair value gap. That's why the market went up to that level here and went beyond the previous 15-minute. Right here, see this gap here? This gap, we're looking through that to the left. That's why we're not supply and demand, folks. Sorry, Sam Ziden. This right here is a buy side imbalance, sell side inefficiency. The market trades down through it. The market trades back up into it. This is a small little inerrant price action. It's a mohawk. It's a little nickname I gave it. Small little tiny little movement outside of it. There's no body outside of it. It's just a wick. That's completely normal, completely acceptable. We don't worry about those things. The market shows a willingness to respect the inversion fair value gap, and then breaks lower, institutional order flow entry drill. And then we have this wick, big wick here, okay, which doesn't do much in terms of damage below this low for sell side. So once we move through it, I liked this gap, but I wanted to refer back to this wick. So does this market respect that wick's consequent encroachment? I don't know, does it? It's perfect, isn't it? Look at these candles here. The bodies tell you the story. The wicks, they do the damage. And this is telling you narrative. It means the algorithm is in a sell program. It's going to seek sell side liquidity. It's going to run on sell stops. It's going to run to inefficiencies. Well, there's a small little inefficiency remaining here. It gets down to it there, comes back up into a small gap there, and then does what? Dives for the sell side and gets below the weekly TGIF, 20% of the weekly range. I went short on here, trading inside of the idea that we are in this inversion fair value gap there. I took a little bit of heat on it, but not much, and then aggressively ran for the sell side, and there you go. So that's what I used to teach my son on Friday afternoon. Notice where we closed. Look at this. Real close to the 20%. These things are not coincidence. They happen every single week, and sometimes there are certain parameters that are met that allow for explosive runs. What took place? What took place this week? Think about it. What's occurring on the daily chart? Fair value gap. Boom. Third week of what? Third week of what? June. Just like that seasonal tendency calls for. Folks, those things are like roadmaps. And we knew in May, when the seasonal tendency that I like to see, where if it sells off, if I can find something technical that aligns with the market to see it go lower, if it's not providing that, that means we are really bullish. S&P went up over 400 handles. Look at the NASDAQ. Almost 1,000 or more. From this turning point right there. And then rips again in July. This move right here, this is a classic in the summer months. That part is, that's a classic scenario. If you're in a bull market, this is what you expect in the months of June and May. If we're in a bearish market, a sell-off in May into June, they're very, very good. That's how you use seasonal tendencies. The idea or premise behind a seasonal tendency that is failing and being instrumental to having a market go explosive, in the opposite direction to what the seasonal tendency would imply. But in terms of seasonal tendencies, the idea of when a seasonal tendency is failing to manifest itself, that is many times, not always, but many times it is conducive for an explosive price run in the opposite direction to what you would expect in the seasonal tendency. So because we had the potential sell-off in May, didn't form. It did not form at that time. So that gives more rocket fuel for the June low that forms, and that's classic in stock index futures. But what I'm showing you here on this daily chart, how's that any different from what I'm teaching you on a 1-minute chart, 4-minute chart, 5-minute chart, 15-minute chart, hourly chart? It's nothing different except for the time frame. Isn't this something that we would be looking to get long on anyway if we're bullish? Yes. What is this here? High and that high. That's relative equal highs. That means what? There's buy side above that. We're not looking at that as going back up to this here as resistance. We're looking for it to trade through it. Does that sound like resistance to you? What kind of resistance would that be?